Welcome back to Alpha Recap. I'm glad you tuned in after the close. Markets closed with a bit of a shuffle today, and we've got a full breakdown of what moved and why. As always, if you have questions while you listen, you can reach us at stockalpha.ai.
Great to be here. There was a lot packed into the session. Policy headlines, big capital allocation moves, and a fairly dramatic crypto episode. Plenty for investors to unpack.
Let's start big picture. How would you summarize the day in one line?
Markets closed unevenly, with a clear tilt toward defensive and infrastructure-oriented sectors, utilities, materials, and certain parts of real estate, while riskier exposures like crypto and some finance names took hits.
There's a neat three-part theme running through everything, right? Policy, capital allocation, and macro. Walk us through how those three forces showed up today.
Absolutely. Policy and regulatory headlines were front and center. Everything from a Department of Justice probe into a big streaming company to changes in nuclear licensing chatter. Capital allocation showed up in big buybacks and trophy real estate deals, and macro was visible through a steeper treasury curve that altered how investors priced growth versus cash flows.
Okay, let's break it down, sector by sector. Utilities kicked off the winners. What happened there?
A cluster of constructive items landed for utilities. Rolls-Royce made progress on small modular reactor controls. Xcel Energy locked in supply for roughly 6 gigawatts of data center demand. And we saw meter upgrade pilots moving forward. Those stories helped regulated and quasi-regulated names outperform.
So why do those specifics matter to someone who owns utility stocks?
They matter because regulated utilities have clearer pathways to recover project costs through rates, and large offtake deals, like corporate demand from data centers, shorten the financing timeline for renewables and storage. In plain terms, it makes projects less risky and the cash flows more visible.
Materials and mining were also strong. What drove flows there?
Project starts and public funding drew attention. We had a 20,000-meter drill campaign in Quebec announced, plus new funding for processing and recycling facilities. That kind of activity looks like direct benefit for critical minerals tied to the energy transition.
Investors love tangible timelines. If you're a miner, drilling and funding reduce the long wait for cash, right?
Exactly. It reduces the geopolitical premium and gives clearer dates for when projects might convert to cash, which is very appealing when headline risk is high elsewhere.
Real estate had selective strength. Tell us what stood out.
We saw active capital flowing into trophy hospitality. For example, a big purchase of a Ritz-Carlton asset in New York, and steady demand for industrial logistics, especially near cloud hubs. That showed investors were willing to pay up for high-quality, cash-generating assets despite rate uncertainty.
Now the painful stuff. Crypto had a pretty rough day. Could you paint that picture?
It was stark. Bitcoin dropped by roughly $10,000 intraday, and Ether followed. That triggered record liquidations in leveraged positions, ETF outflows, and renewed questions about counterparty risks at lenders and funds with exposure to tokens.
Record liquidations is dramatic. For listeners who don't trade crypto daily, explain why a big price move can cascade so quickly.
When prices fall sharply, leveraged traders get margin calls. If they can't cover those calls, their positions are forcibly closed, which pushes the price down further and creates more margin calls. That cycle can rapidly amplify the initial move. And because some funds and lenders were holding token exposures, it spilled into broader risk sentiment.
And that spillover hit finance and banking names too?
Yes, finance had a rough day. A steeper treasury curve altered trading dynamics, and some banks faced caution on funding and trading lines. Income-oriented names held some ground, but overall risk aversion rose.
Let's talk about technology. Some winners and some hair-pulling moments there.
Technology was two-speed as usual. Big buybacks and fresh AI funding buoyed select names, but regulatory headlines, notably a Department of Justice probe into a major streaming company, and warnings about chip shipments to China kept volatility elevated.
Buybacks versus regulatory risk. How should investors think about that trade-off?
Buybacks can support near-term equity returns by reducing share counts and signaling management confidence, but they don't change the impact of a regulatory action. So companies with large buybacks but high enforcement risk can still see outsized stock moves when headlines drop.
Consumer was interesting too. Amazon passed a milestone today, right?
Yes, Amazon surpassed $700 billion in annual sales, which reinforced the logic behind more logistics spend. For example, FedEx filed for a sorting hub of about 1.6 million square feet, showing the infrastructure investment pattern tied to e-commerce strength.
Energy was mixed. Give us the short summary.
Oil paused after a recent rally, and a major integrated announced an investment pause that signaled more disciplined capital spending. At the same time, renewables, hydrogen, and storage projects continued to get awards. Chinese photovoltaic manufacturers warned that 2025 could be painful for margins, so the sector is bifurcated.
That's a lot of nuance. So, for renewable developers, it's generally positive, but for commodity PV makers, it's tougher?
Correct. Developers and storage companies with secured offtake are advantaged, while commoditized PV producers may see margin pressure until demand and pricing clear up next year.
Healthcare and communications had their own headlines. Quick hits on those?
Healthcare showed clinical wins and more AI pilots, but policy moves, like Medicaid data changes and telehealth debates, limited broad enthusiasm. Communications and media were driven by content cycles and reputational events that can create concentrated stock moves.
Let's pivot to correlations and cross-sector themes. What patterns stood out today that investors should keep watching?
5 things jumped out. 1. Policy and regulatory headlines are the dominant cross-sector driver. 2. The energy transition is linking materials, utilities, and real estate. 3. Capital allocation is reshaping returns with buybacks and asset sales front and center. 4. Rate dynamics, especially a steeper treasury curve, are changing how investors price banks and long-duration assets. And 5. Crypto showed how liquidity and leverage can create rapid contagion into other risk assets.
Actionable advice time. In plain English, what should investors consider doing right now?
First, favor cash flow quality. With headlines causing episodic volatility, overweighting utilities tied to grid projects and materials with near-term contracted work can reduce drawdowns. Second, be selective in energy. Favor storage and secured offtake rather than broad exposure to commoditized PV makers. Third, treat crypto as a high-volatility satellite and tighten position sizing if you hold it. Fourth, rotate to defensive real assets like industrial logistics near cloud hubs and trophy hospitality that have clearer cash conversion timelines. Fifth, watch capital allocation signals in tech and energy. Buybacks help but don't eliminate regulatory risk. And finally, prepare for headline-driven volatility with tools like options or staggered entries.
Those are solid, actionable points. Any specific red flags to monitor in the next week?
Yes. Watch for continued crypto volatility spilling into ETFs and money markets, any sharper moves in treasury yields that would reprice growth and REITs. New regulatory developments in tech and communications, and project execution or permitting delays in major materials and utility projects that would push cash flows out.
You mentioned buybacks a few times. For listeners who might not follow corporate finance closely, remind us why buybacks matter now.
Buybacks reduce outstanding shares, which can lift earnings per share and support stock prices in the near term. They also signal management confidence in the balance sheet, but they don't immunize companies from regulatory shocks or macro stresses, so they're a support tool, not a cure.
Let's close with a concise list of takeaways for portfolio positioning.
Keep it selective and defensive. Favor balance sheet strength and cash flow quality, overweight utilities and materials tied to funded projects. Be selective in energy and avoid broad PV exposure for now. Treat crypto as a small, high-volatility allocation. Watch capital allocation cues like buybacks and M&A, and expect headline-driven volatility. hedge or stagger entries rather than making single large moves.
Perfect. Any final thoughts before we wrap?
Just that the longer-term structural themes, AI, the energy transition, and onshoring, remain intact. Today was a reminder that short-term noise will keep creating tactical opportunities, so staying nimble while prioritizing quality is the winning posture.
Great summary. Thanks for the clarity. That's our recap for today. Utilities, materials, and parts of real estate held up. Crypto and parts of finance came under pressure. And the three big drivers were policy, capital allocation, and macro. If you'd like to dig into any of these moves, we'll be happy to help.
And remember, if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.